The order in which distributions are paid in a real estate syndication investment is called the capital stack. And your clarity on this concept is critical because you need to know where you fall in order of priority for returns. Understanding the priority in which returns are paid in a real estate syndication will also allow you to select syndication deals in which the capital stack is favorable toward your investing goals. Hi there, I'm Nima Segarra, founder of Nima Equity. Today, I'll share what the capital stack is, why it's essential, and how it impacts you. The way the capital stack works is called a waterfall. Imagine a list of everyone participating in the deal with the debt and equity partners categorized into groups, organized with those with the lowest returns and highest priority at the top. When cash flow is available, it gets distributed like a waterfall, starting at the top and trickling down to those with higher returns and risk toward the bottom. The waterfall structure is outlined in each deal's PPM or private placement memorandum at the beginning of the deal. It explains who, how, and when each partner, whether general or limited, gets paid during the life of the deal. Some classes may receive only cash flow, while others take part in cash flow distributions and capital return profits when the property is refinanced or sold. You want to understand where your potential investment is in the waterfall structure and which pieces apply to you and how they might help you toward your financial goals. The impact of the capital stack affects investors in three main ways: cash on cash, IRR or internal rate of return, and velocity. Cash on cash returns is the before tax earnings an investor makes on their invested capital, also referred to as cash flow or distributions. If you are in the preferred tier, you may have more significant cash on cash returns. IRR is a metric to measure the deal's profitability, cash and equity. It's a fancy way of calculating your return while accounting for the time value of money, a concept that holds today's money more valuable to you than that return to you in the future. Velocity is your ability to invest in more deals at a faster rate. As an example, when a deal gets refinanced, you may get some capital back if you are participating in a capital returns position. You could take that return capital and invest in another project. The capital stack in a real estate syndication investment is where debt and equity partners are ranked in order based on an inverse relationship between risk and priority. The highest priority, lowest risk partners are toward the top of the capital stack, while the lower priority, higher risk partners are toward the bottom. At the top, you always have what we call senior debt. This includes mortgages and loans to finance the property. Just as you would never miss a house payment, the senior debt is the highest priority and they get paid first. Next, there are second-level mezzanine-type loans like second mortgages and bridge loans. Continuing down the waterfall, you will see preferred equity or limited partners come next. Following the preferred equity partners are the common equity or general partners. There are two main types of capital stacks: single and dual tier. To make things easier, I will leave the dual tier capital stack for another occasion. In a typical single tier capital stack, senior debt is at the top, carrying the lowest risk and ranking highest in priority. Then you will see the common equity class A preferred return below the senior debt, carrying a little higher risk and a slightly less priority. This will likely be the passive investors or limited partners in a single stack. These limited partners are likely participating in capital returns and will receive a portion of the profit after the sale too. The last level of a single tier stack is common equity class B. These are likely the general sponsors or syndicators who carry the most risk and are last on the priority list. As I mentioned before, the capital stack and the waterfall schedule are outlined in the PPM or private placement memorandum and are available to you as a potential investor before you commit to the deal. But the PPM details might seem like gibberish if you aren't clear on the capital stack, how it works, or where you fall in priority for distributions. Now that you have a more solid explanation, your confidence in reading any PPM and selecting a real estate syndication deal that is in alignment with your investing goals will skyrocket. I'm Harry Nima Segarra, founder of Nima Equity, and I would love to share upcoming syndication deals with you. Join the Nima Equity Doctors Investing Club today to get the inside scoop on past and upcoming deals. Once you apply to join the club, we can get on a call to see if we're a good fit to invest alongside each other on any future real estate syndication deals.